Well, good morning again, everyone. Thanks so much for joining me for a chat this time about the stock market crash of 2022. Well, or should I say the supposed stock market crash? I guess it depends a little bit on what your definition of a stock market crash is. I've taken this one from money.usnews.com. Stock market crashes are frequently confused with market corrections, but there are specific thresholds for each. Well, I'm not sure that there's actually a definition of it, but they're claiming that they seem to know one. A stock market crash refers to a drop of 20% or more from a recent high, and I think this is probably the most important thing to be considering if we're going to be talking about whether we are currently in a stock market crash. We need to look back to when was the most recent high and how far have we fallen from that, while a correction refers to a drop of 10% or more. Now, way back when Invest for the Future was operational and I was able to talk about individual stocks, I did do a video on how often we do see these corrections, and they are quite common. Often sort of around about every 12 to 18 months roughly, you do get a drop of 10% or more in the market, and sometimes it does turn into a fall of more than 20%, but whether that determines whether it's a market crash or not is a matter, I think, of personal opinion. So yeah, we're going to have a look today about whether we are in fact in a stock market crash at the moment, or is it more of a correction heading into more of a long-term bear market. So what's your definition? You know, you need to think about, well, it probably doesn't even matter whether you think we're in a crash or not. The market at the moment is heading southwards, sort of, and so does it feel like a crash to you? Does it feel like we're heading a lot further, or is it something that's just going to be managed by central banks and by the market itself, and with the notion perhaps that high quality companies will be able to work their way through the difficulties that are facing them at the moment? Well, you know, if you go to YouTube, and here we are, I'm on YouTube, you get all sorts of interesting stuff coming up. And I just want to talk a little bit about Michael Burry, who seems to be one of Brandon's favourite investors, and he's suggesting in his most recent one that Burry is warning of the 2022 stock market crash. 3.1 million views. Wow, I wish I managed to get that many. That would be like an instant $40,000 odd coming in through my AdSense for a video that had 3 million views. But anyway, that's another story. Burry, of course, is a very confident man, having predicted the housing market issues around 2008. And he has quite a strong opinion of his own ability to foresee the future. Whether he's correct or not is another issue. What is interesting, particularly about he and Warren Buffett, are their views on Apple. Burry's claiming that Apple is about to go bankrupt. That's according to this particular video from Business Basics. I haven't watched it. And he's also claiming Bitcoin is going to go to zero. Well, in fact, of course, Bitcoin advocates of which are claiming that it's the place to go, a haven of safety or whatever, a repository of value and wealth. Well, certainly hasn't been the case in the last 6 months, having fallen from 90,000 Aussie dollars down now, having broken through what was an important level here at 40,000 and trading down now at 30,000. So that's a loss of, you know, over 60% in value in the space of 6 months, way worse than anything the market is sort of throwing at us at the moment. But yeah, I know nothing about Bitcoin, don't understand it, makes no sense. So let's move on from there. And of course, talking about, you know, a market in crash mode, certainly wasn't in crash mode last night as I record this in the middle of Saturday. Market up 3% over in America, S&P 500 up 116 points on the day. And so if we actually have a look at what's happened to the US market, it actually is not now down more than 20%. It was over here, but currently from the all-time high back here at the start of the year. We're now down only 18.4%. Now, the issue, of course, we have is this succession of lower lows and, of course, lower highs along the way. You know, trying to predict what's going to be happening from now on is going to be a challenge, as I always say. And until we can actually see the price get above this most recent high, it's probably fair to say that we are definitely in a bear market at the moment. But is it a crash? I'm not seeing it as a crash myself. Certainly, you know, the most recent high is here, and okay, it's fallen down quite a bit from there. But in terms of falling from this all-time high, it's taken like nearly the best part of 6 months for it to get from that high all the way down to where it is now. So I'm not seeing that as being a market crash, but certainly having a negative impact on most people's portfolios. Key level probably is this one here. Was a level of support. Now it's a level of resistance, so 41.75. So we got a bit of a way to go there. It's around about a 7% rise from here to take us up to this key level. And when I cranked up the internet today, I spotted that in my feed yesterday, the AFR was saying the ASX was going to slip, even though Wall Street rallied late. The price of copper had dropped, but yeah, the Aussie market was going to slip, and yeah, there we were at the end of the day. I had one of my best days over the last couple of months, and the market all up was up about 0.6%. So much for the AFR knowing what's going on. And then 4 hours ago, they're reporting that the S&P 500 is poised to rally up to 7% next week, according to JP Morgan. Well, if it does that, then it will be going up to that key support and resistance level, as I indicated in the previous couple of slides. Now, you know, what's the strike rate of these guys being right? Not very high, I've got to say. And so, you know, trying to take cues from Australian Financial Review or JP Morgan or Buffett or Burry or whatever, to me is not a recipe for disaster, but something you need to think twice about before you act on anything that they might have to say. And so there we are, the market, if it does go up by 7%, according to JP Morgan, will be at this key level. And then if it happens to break through that, well, okay, all those technical analysts might be saying, oh, the fall from favour is over and the market is about to head up, at least in the US. Now, you know, we're talking about Burry and Buffett. Now, here's Burry's portfolio. Now, he's claiming that Apple is going to zero, and he's taken a big put position on them. So in other words, he's betting that the share price for Apple is going to go down, and he's got nearly 18% of his portfolio in those put options. He's got nearly $36 million invested in them. At the same time, Warren Buffett, he's got a positive view of Apple in the sense that he's got 890 million shares of Apple's worth $155 billion and constitutes 42% of his portfolio. They can't both be right, you know, and so therefore, you know, there's no way that we should be paying, you know, absolute total attention to any one particular commentator, and in this case, investor. Buffett and Burry, they can't both be right. Now, maybe neither of them will be right, and in fact, the Apple price will just go sideways forever. Well, that won't happen, but they're not going to both make money out of their current positions in that particular stock. Now, you know, for Buffett, you know, trying to get out would be a bit of a problem. As I said, he's got nearly 900 million? There we go. Nearly 900 million shares. And when you have a look at the average daily trade on Apple, it only trades around about 100 million shares. And so therefore, he would not be able to flood the market with his stock. And so he's pretty much stuck with it. And I guess he's had the view that he's happy to be there. He does trim it around the edges. If you have a look here, we can see that his previous percentage of the portfolio was 47.6% of his portfolio. It's now down to only 42% of the portfolio, but that's because the share price has been falling. In fact, he's actually been adding to his position, adding nearly 4 million shares, and this is from the period January 1 through to March 31. So, we're not going to know until we get to the end of June when the 13F filings come out what he's actually been doing with his position. But yeah, he's got such a big position here, it's unlikely he's going to be able to, if he changes his mind, get out in any great big hurry. But moving on to the point of the video, and I've taken a bit of a time to get here, it just come from the result of a couple of people asking me, how long do corrections usually last? And if we do have crashes, how long do they usually last? And so I've done a little bit of research, gone back using tradingview.com to have a look at the chart for the S&P 500, and then I use Stock Doctor to get access to the charts for the All Ordinaries from 1980. And let's have a look at the corrections and the crashes as they appear according to my view of what the charts were saying. And so I've gone back to 1980, and from there onwards had a look at where has there been a fall of more than 20% in the S&P 500 and also in the All Ordinaries, and then had a look at how quickly did those falls occur. And so let's just go through history slowly here, getting a sort of a feel for how often do we have crashes and how long do they tend to last for. And first of all, starting at November 1980, the S&P was at 142. It took nearly a year, 10 months for it to fall by 20%, and then another 11 months before it bottomed out, 11% lower than that. Now, to me, that is not a market crash, even though the market has fallen by around 30% overall. I would call that a big bear market. And in the case of the Aussie market, pretty much similar results, although the falls were even more pronounced. Starting from November of 80, it took nearly a year, 12 months or so, give or take a few weeks, to reach that 20% fall in value, and then followed up with another 22% fall from that, going from 589 to 461. So I would just describe that as a period where we were just in a very big bear market for what is pretty much the space of 2 years. Moving on, it took a while, another 6 or 7 years, before we then got to the market crash, and that was an absolute crash. August of 87, S&P was at 338. By October of 87, it had fallen to 270, and that only took 2 months to happen, and then it continued falling during that month by another 20%. So absolutely a crash. That was that recent high, and then very, very quickly falling. So we had a market crash there. And in the case of the Aussie market, that crash was even more pronounced, down 20% in the space of 2 months, and then 1 month more of falls for another 38%. Very, very worrying, but it didn't take long for it to turn around and correct. And as you can see here, by the time we got to July 90, the US market was well above the high that it was prior to that crash of 1987. Now, in the case of the US market, it took 3 months for it to fall by 20%, but then it only fell another 1 point during that month before it then started to turn around. So we had what was pretty much a correction, but certainly was not a crash. In the case of the Aussie market, down by 20%, took 12 months to get there, and then another 4 months to fall another 16%. I wouldn't call that a crash. I'd call that another big bear market. And then the Aussie market had 2 more occasions where it fell by 20% and then corrected very quickly after that. So, we're getting this sort of tendency here to, once we hit that 20% mark, the market tends to say, yep, that's enough, and it starts to turn around and head back northwards. Then we come to a really, really interesting period in July 1998 through to October 1998. that was definitely a crash as far as I'm concerned on the US market. Fell by 20% in 2 months, and then another 1 month before it reached the bottom. But that's a very quick fall from grace. I call that a crash. At that particular time, the Aussie market did not fall by more than 20%. But here's another super interesting period. This is the dot-com bubble. Over in America, it took 11 months for the market to fall from 1553 down to 1242 in early of 2001, and then it took another 20 months for it to fall another 38%. Now, is that a crash? I would say not. I would just say it's a very big bear market. But have a look at what happened in the Aussie market over the same period. Over that period from August of 2000 through to July of 2001, the Aussie market only fell by 1%. And then until October of 02 fell by another 12%. And that was 15 months for that to happen. And so pretty much across the period where the US market fell by more than 50%, the Aussie market only fell by a bit over 12%. And so therefore there was this absolute disconnect, and that's probably pretty much understandable because there would have been very, very few companies in Australia involved in that IT space and the dot-com bubble that basically gripped the American market. We then move on to the global financial crisis. That was definitely not a crash in my view. It took 9 months for the market to fall by 20%, and then another 9 more months before it fell another 47% in America, and the Aussie market did very similarly. So I'll just describe that as a big bear market over a long period of time. We then come to 2018. In a very short period of time, the US market fell by 20% and then quickly corrected after that. Aussie market did not experience that. We then come to the COVID crash, and it was an absolute crash, wasn't it? Very quick sell-off of more than 20% and another 19% within that month. Australia did slightly worse. And right now, we're in a period, I think, of correction at the moment. And I haven't updated this with the rise overnight in the US market. But this is not really looking like a crash to me at the moment. We're up to nearly 5 months now, and the market is down by about 18.5%. So, there are some numbers there for you to think about. Quite often, when we get to this 20% mark, that's the bottom of the market, it would seem, and then the either goes sideways for a while or it then starts to correct upwards. And so if we're looking at it from my perspective, in terms of the Aussie market, only 2 crashes in the last 40 years. In the case of the American market, 1, 2, 3, 4 crashes have occurred using that definition of a more than 20% fall from a recent high. And I guess it's a question of what would you consider a recent high to be. And so just to sort of wind this all up, this is the chart from marketindex.com of the All Ordinaries Accumulation Index on an annual basis. So this is a calendar year basis of the historical returns, and you can see that only 1 year out of the last 40 years have we had a market return that is below a fall of 20%. Now we're definitely in negative territory here, and it's probably hard to see how we're going to have a green bar for 2022, but generally speaking, we can see that the market does tend to want to go up, and around about 3/4 of the time you're going to have a positive return from being invested in the Aussie market, and the same sort of thing would happen if you're invested in the US market as well. Again, trying to predict the future though, pretty challenging. Right now, looking at PE ratios for the Aussie market, the Aussie market's PE ratio is currently 14.63 according to Stock Doctor, and right now that is below the long-term average. And most recently there was this over-exuberance where some companies became ridiculously expensive, and that is now corrected down. So just quickly summarising then, our market It did get into a correction way back here at the start of the year, but only lasted as a correction for a couple of days, and then it managed to work its way back almost up to another all-time high before it's now in this correction again. And so looking at it in the long-term picture, over the last 10 months or so, the market fell down by 15.7%, so that certainly was not a crash, and certainly not over a long period of time. Maybe if you looked at from here to here, heading perhaps towards a crash, but not really, I don't think. Right now we're sitting up here, and we're sitting with now a retracement, if you like, a correction of 13.8% from this recent all-time high. Yes, of course, it's a stronger fall from this high, which was only a couple of months ago. We're now down 13.4%, but not crashing at the moment. Yes, we're in a big bear market, I think, at the moment, and I guess needs to consider some things that, is inflation under control? I don't think so. Will interest rates rise? Yes, I think so. Some companies are definitely going to be filing for bankruptcy, perhaps more than would usually be the case. And the sort of companies that will be filing for bankruptcy will be those that are relying on borrowings. And as the interest rates rise, as those debts become due, they will not be able to repay the debt, will not be able to refinance, and so therefore they will be going into bankruptcy. However, predicting what will happen in the next 6 months could be a nightmare and not even worth making the attempt. Some of these things you see on YouTube, channels predicting gloom and doom, look, they may very well be correct. Ray Dalio, I see, is still barking on about the market falling 70%, and I think Robert Kiyosaki, is that his name? Robert, yeah, that rich man, poor man dude, he's predicting 80% fall. Well, they might be right, they might be wrong. All we do need to know, though, that is over the very, very, very long term, despite all of these dire occurrences on the market, it's delivered some pretty reasonable returns if you stay invested over the long term. So whatever the case, I hope that your strategies are working for you. I do hope you have a plan for managing what could be some very tricky times ahead. And as always, thanks so much for watching, and I'll catch up with you again very soon.